Is the worst behind us, though? Joining us now is Jared Weisfeld of Jefferies. Any reason to think it is, Jared, or give me the reasons it might be, reasons it might not be?
For sure. Good morning, Joe. Yeah, listen, I think there are multiple silver linings that are, quite frankly, overlooked right now. The tech sector has obviously gotten hit incredibly hard as the 10-year has moved from 1.5% to 3%. And it's the sector that's most sensitive to a rising interest rate environment. But let's take a step back here. MFANG as a category, you look at large cap tech, very reasonable valuations, right? We're talking about 12, 13 times EBITDA. Google is trading at an S&P earnings multiple. Facebook is at 7 times EBITDA. So we've really had a ton of carnage in large cap tech. Look at the software sector, right? All of software right now is being sold hard. Long duration assets, those names that are trading at greater than 8 times EV to revenues, are down 50% year to date. And while there's a ton of selling pressure that's clearly been impacting the sector, private equity is emerging as a strategic bidder, right? We have $70 billion of M&A over the last 2 to 3 months at very full valuations. And semis are actually starting to outperform. If you look at over the last 3 to 4 weeks, semis are starting to outperform relative to the S&P. And earnings season has actually been really, really strong from a semi standpoint. So I actually do think that there are pretty significant silver linings underneath the surface.
Valuations, when they're very rich, might be meaningless because of stocks become loved or whatever it is. But when valuations get to where you just stated on a lot of these, that's hard to ignore long term. That gives you some type of confidence and maybe some type of floor where it may overshoot as people get negative and are forced into selling for whatever reason. But that's something you can sort of be confident. That's all you can use. That's all you can do in this business, I think, is just try to stack things in your favor. So that's all, that's all pretty positive, what you just came up with. The only thing I'd say, Jared, is if we don't know about inflation and where interest rates stop, multiples could even get much worse than what you're talking about now. Like in past bear markets, what do they can get to, ridiculously low levels.
For sure. Listen, when we always can overshoot on the downside, but we do have, while inflation is clearly unprecedented for our lifetime in the context of what's been going on over the last 20 to 30 years, when you think about the fact that we do have a benchmark in terms of going back to 2018, right? The 10-year was at 3.25, and we do have the ability to see where some of these valuations can stretch to the downside. But you're right, the CPI print in an hour is obviously going to be incredibly important here. And I think let's also not forget the really difficult CPI comps that we're going to be having here over the next 2 to 3 months, right? The chairman obviously knows this. And, with him doing, a relatively dovish hike last week in terms of taking the 75 bips off the table, if we do have a situation where inflation comps starting getting a little bit more difficult, you do have some more benign CPI prints, there's been so much money that's been taken out of the sector, you could really have a vicious rally to the upside.